In this video, we're going to take another deeper look, I guess, in portfolios and how we choose portfolios and how this ultimately works inside a corporation. And many people ask this question. They basically say, well, why are we talking so much about portfolios? I mean, this is a corporate finance, intermediate finance course. Why are we spending time with this, what certainly appears to be an investments a topic? And the idea of a corporation, in fact, there have been definitions of a corporation that refer to a corporation as a nexus of assets. That is, it's a collection of assets. So every asset that the company owns can be analyzed as to how that asset impacts the risk and return of the portfolio itself. Think about a business that might only, let's say all we do, our business is snow blowers. So obviously in the winter months, we're going to sell some snow blowers, but in the summer, not so much. So that unevenness in our cash flow stream creates problems. I mean, it might be perfectly fine with us, but we just have to understand that the variation throughout the year is by definition risky. So what if we add something else? What should we add? Should we add snowmobiles? Well, no, because that really hasn't fixed the idea of these uncertain cash flows throughout the year. So maybe we want to sell lawnmowers. So now we've smoothed out the income stream. So understanding how corporations are put together is why understanding portfolio theory can be so important for us. So let's continue down our road here. And again, we want to talk about risk, right? We're talking about this bottom part. How does the risk of the company, how does it influence the cost of equity, which ultimately has an impact on the value of the firm? So the first thing we want to talk about here is just portfolio theory in general. So we have two assets, A and B. We know what their return, we know their risk, we know what their correlation is. So what happens if we create a portfolio with these two assets? So we want to look at, again, this is a worksheet. Bring back our worksheet. In this case, it's the portfolio risk and return worksheet. And the reason we use this worksheet is it utilizes the correlation. So when we calculate risk, knowing from previous videos, we talked about how the relationship of assets has an impact on risk. So we have to understand how correlation, this relationship between the stocks, how does that affect the overall risk of the portfolios? So again, we can put in weights, returns. Here we also, though, if you notice, the thing we have here is it asks for variance. And the reason is because the formula for risk is a little bit complicated when it comes to the correlation piece to it. So using variance makes the math a little bit easier for some of these calculations. But you're hardly ever going to be given variance as a factor or as a variable. You're almost always going to be given standard deviation. So in this case, if we go back here, it was excuse me for let me see. So if we go down here, we know that the risk is supposed to be 20%, right? Or the standard deviation. So we need to input variance that's going to give us a 20% standard deviation. Standard deviation is the square root of variance. So all we do is square standard deviation. So if you do equals 0.20, Now we need to square that. If we square that, we get a variance of 4%. The standard deviation is 20%. That's the only real trick, if you will, with this particular spreadsheet. You put in the weights, the returns, variance, betas. We need to know what the correlation is between the assets. And again, that will help us again calculate the overall risk return of these portfolios. So again, if we kind of think about this, what would happen? We have a correlation of 0.35. What would happen, you think, if the correlation was not 0.35 but was negative 0.35? Well, in fact, if you wanted to do this, I would open this spreadsheet, put the data in there, and see what happens. I'll tell you what does happen, though. If you change the correlation to negative 0.35, what you will not change is the return, because the return is just the weights times the returns. So correlation, standard deviation, has nothing to do with the returns that you receive from the portfolio. But if you change this to negative 0.35, standard deviation for this portfolio changes to 26.5. So it obviously gets smaller. Why does it get smaller? Because now we have a negative correlation, a lower correlation, if you will. If the correlation were 0.85, again, the return doesn't change, but the new standard deviation would go from 30% to 33%. So again, we can incorporate this. The times you use this portfolio risk and return worksheet is when you know the correlation of the assets, or when it's part of the problem. So let's continue and talk about how we create portfolios, or how we choose them. So this picture represents what they refer to as the feasible set of portfolios. It essentially is the universe of securities. So inside this red thing in the middle here, right, in this area, right, and everywhere out here, right, these are all data points of risk and return, right? Here's risk, here's return. All data points of risk return that represent individual assets or portfolios created from those assets. Now, theoretically, this set is the entire set of all investments available in the entire world. Obviously, it's very difficult to create that portfolio. Typically, we'll end up using the S&P 500 as our feasible set because it's a known quantity of assets, if you will. The efficient portfolios is that set of portfolios at the very upper red range here, right? So the efficient portfolios are the only portfolios that you would want to invest in. So the question is, why is that true? This set, the efficient set, maximizes return given risk. So if you notice, there are no portfolios up here, and there's none over here or down here even, right? Because there's no risk return combination of any asset that falls outside that range. So as an investor, you certainly want to maximize returns, but you also want to minimize risk as much as possible. That's this efficient set. So could you choose this asset? Certainly you could. But there are other investments above that, up to this red line, that have the exact same level of risk but more returns. And likewise, moving here, all of these have the same returns, but everyone has less risk. So this upper boundary here is the set of portfolios that we want, right? That we would be willing to invest in. So that provides us with that one set, if you will, and we refer to it as either being the efficient set or the efficient frontier. So again, let's just kind of restate this another way. The efficient frontier represents the investments that investors desire. It provides the greatest return at the lowest risk. But in general, now we have this set. So the next question is, which one of those things would you as an investor want to choose? So now we need another tool to create, which is called an indifference curve. An indifference curve measures a person's risk tolerance. And essentially, we create a series of curves. They look like this. And everywhere on this curve, that portfolio has the exact same risk. So again, remember, we want to maximize return for a given level of risk. So that means we want to find investments in this northwest kind of direction, and we want to find the one that's going to provide the greatest amount of return. And as we go upward, we get to less and less risk. So we want to find a tangency point. So what does this picture look like? So here's our efficient set, right? We know that from here up and around, right, up around here, these are the only one that's important. And we have two investors, investor A and investor B. Investor A is very conservative, very sensitive to risk. So they're going to want this portfolio here. Now, this is an entire plane of curves, right? It's an entire plane. You just got to find that one that's tangent here. Likewise for B. There's all kinds of these, right? It's an infinite number of indifference curves, but only one is going to be tangent to this efficient frontier. And for this particular portfolio, that is the asset. That's the portfolio that you want to buy. For you as an investor, based on your risk preferences, that is the one that's going to make you the happiest, right? They refer to it as your optimal portfolio. So we're talking about this theory called the capital asset pricing model. We've previously talked about something called the security market line. That's a formula that comes from CAPM. But what we never really have mentioned any of the assumptions of the capital asset pricing model. There are three primary ones we need to think about. First of all, this is a single holding period. We're only looking at one period. Next, investors, all investors, have identical expectations. So if we had a room of 100 people and we all gave them some information, they would all come to the exact same conclusion. In addition, investors can borrow or lend unlimited amounts at the risk-free rate. Well, that's a bit of a problem because the only thing that can borrow at risk-free is the United States government. Now, we can lend at the risk-free because I can buy Treasury securities. So these three assumptions, and there are a few others, but these three assumptions essentially aren't very rational, right? They're not logical. But this is what sets the ground for the mathematics that can help us understand how risk and return are related. So what does the risk-free asset do to this efficient frontier? What if you add this asset? So now we have on that curve, we have all the risky things. Now we're going to add a risk-free investment. What this does is it creates a straight line relationship. So here we have the risk-free asset, and we see where this line, we just take this line and essentially think about it, we drop it down till it touches this curve. Where it touches this curve, we have this portfolio M. It's referred to as the market portfolio. Now remember, previously I said there's no way to actually measure the market portfolio. When we use the capital asset pricing model, we're going to use the S&P 500 to proxy for the market. It's not correct, but it's close. Okay? So what we find is we have this point M. This point M says that now our efficient frontier is this blue line. So this the theory that's at work here right now is something called the separation theory. The separation theory divides investing into two choices. Number one, let's choose the risky asset. In this case, M is going to maximize the risk-return relationship for all of the risky assets. So everybody wants to buy M, but not everybody has that risk level. So when you now have the combination between that asset and risk-free, how do you choose your portfolio? So if you are, and we'll see this graph here in a couple of minutes, if you are very conservative, again, your efficient frontier, again, is this line, you might want to buy this asset. So you're going to invest, you're going to buy some treasury securities, and you're going to buy some M. If you're very aggressive, right, and you're not very sensitive risk, you might want to be up here, right? And up here, you're going to actually borrow at the risk-free rate of return, take that money plus your investment money, and you're going to invest in M. So you only have two assets, risk-free and M. Which one you choose depends on your indifference curve. Now what this does, this is what's referred to as the capital market line. It creates a new efficient set. And again, the capital market line, it's a linear combination of risk-free and portfolio M. Anything that's below this capital market line is inferior, right? So we have to choose something, again, on that line. And that essentially is what our indifference map is going to do. So this person here for this indifference curve, they want this particular asset, R, because that's going to be the maximum risk-return relationship based on the indifference curves of the investor. So this ultimately is how we choose our portfolios, right? The separation theory says there's really two things. You think about what you want to buy. In this case, M is the best. And then you think about how you're going to finance it. How do you finance this purchase? You either split the financing by buying T-bills, right, or treasury securities, which puts you in this conservative area, or you borrow at the treasury from the treasury and use that money to help buy even more M. What happens if you borrow more money? Since you're borrowing is riskier. That means your return goes up, but so does your risk level go up. So that's the end of this video. We're going to continue our conversation about CAPM in the next video.